Hello, I'm Cashman. Let me show you how money really works.
The next time you walk into your local bank, take a good look at the person sitting behind that glass desk. They're friendly, professional, and eager to help. But the bank doesn't see your money the way you do. To you, it's your emergency fund, your retirement savings, and years of hard work. To the bank, it's capital. Capital they can put to work. Capital that helps generate profits. Most people believe banks simply protect their money. They do, but that's only part of the story. Banking is a business built on putting money to work. The less you understand that system, the easier it becomes to let your money work harder for the bank than it ever works for you. According to the FDIC, Americans hold trillions of dollars in bank deposits, yet many traditional savings accounts have historically paid interest rates that fail to keep pace with inflation. Think about that. You spend decades working for your money, then your money goes to work for someone else. While your savings appear unchanged, the bank uses deposits to support mortgages, auto loans, business loans, and other lending activities that generate income. Meanwhile, inflation quietly chips away at your purchasing power. Years ago, I believed a growing savings account meant I was winning financially. Watching that balance rise gave me peace of mind. Then I noticed my savings weren't growing nearly as fast as groceries, insurance, housing, and everyday expenses. That's when I realized something that changed how I looked at money forever. Saving money isn't the same as growing wealth. Today, I'm pulling back the curtain on 3 rules financially. Successful people understand that help their money work harder instead of quietly falling behind. These aren't Wall Street secrets. They're practical principles almost anyone can apply. If you have more than $1,000 sitting in a traditional checking or low-interest savings account, today's conversation may completely change how you think about your money. Rule number 1. Stop financing the bank. Most people treat a savings account like a vault. If $10,000 goes in, they expect $10,000 of value to still be there years later. The number rarely changes. That's what makes it feel safe. But here's what many people overlook. Leaving large amounts of cash in a low-interest account is like leaving a bucket of water in the sun. Nobody appears to be taking it, yet little by little, it evaporates. Inflation works the same way. As prices rise, your purchasing power falls unless your money grows fast enough to keep up. Your statement may still show $20,000, but those dollars may buy far less than they once did. Meanwhile, many traditional savings accounts pay only a fraction of 1%. That's not a wealth-building strategy, it's simply storage. The bank, however, puts deposits to work through its lending business. The real question is this: is your money working as hard for you as it is for the bank? Once I understood that, I stopped asking, is my money safe? I started asking, is my money productive? That one question changed almost every financial decision I made. Financially successful people give every dollar a job. Money for bills stays liquid. Emergency money stays available. Idle cash often moves into high-yield savings accounts or money market funds, where it can earn significantly more while remaining accessible. Many reputable online banks offer the same FDIC insurance protection, up to applicable limits, as traditional banks. Their lower operating costs often allow them to pay much higher interest rates. Making that switch won't make you wealthy overnight, but it changes the direction your money is moving. Because wealth isn't usually built through one massive decision, it's built through hundreds of smart ones. Rule number 2. Increase the velocity of your money is where your money begins building momentum. Financially successful people understand one powerful principle. Money has momentum. A dollar sitting still gradually loses purchasing power. A dollar invested wisely has the opportunity to create more dollars. That's why wealthy people don't ask, how much money do I have? They ask, how many of my dollars are working today? According to long-term research from firms like Vanguard, investors who consistently invest over decades have historically accumulated far more wealth than those who leave excess cash sitting idle. The wealthy don't wait until they feel rich. They build systems. For years, I kept saying I'd invest later. After one more bill, after one more raise, after life settled down. But later became years. Eventually, I realized I wasn't protecting my money. I was delaying its opportunity to grow. So I automated my investing. Money moved before I had the chance to spend it. That one habit changed my financial direction. Once you've built a solid emergency fund, every additional dollar should have an assignment. For many people, that means diversified index funds. For others, retirement accounts, dividend investments, or carefully selected real estate. The investment matters. But the system matters even more. Systems remove emotion. Systems remove excuses. Most people spend first and save what's left. Financially successful people often invest first and spend what's left. That's a completely different financial operating system. One creates consumers, the other creates investors. Every dollar should have a purpose. Every dollar should contribute. Remember this: money sitting still slowly loses power. Money moving with purpose builds wealth. And once your money begins working consistently, you're ready for the final rule. Rule number 3. Make the banking system work for you. The first rule protected your cash. The second rule put your money to work. The third changes how you think about banks forever. Most people believe banks exist to lend them money. Financially successful people understand something different. Banks are tools. Like any tool, they can either help build wealth or quietly drain it. Many people experience debt only as monthly payments. But many high net worth investors use debt differently. Rather than immediately selling appreciating assets, which can interrupt compounding and potentially trigger taxes, they may, when appropriate, borrow against certain assets while allowing those investments to continue growing. Notice those words. When appropriate. This isn't a strategy for everyone. The lesson isn't that everyone should borrow. The lesson is understanding the difference between productive debt and destructive debt. Destructive debt buys liabilities. Productive debt helps acquire assets. According to the Federal Reserve, Americans carry more than $1 trillion in revolving credit card debt, much of it at interest rates above 20%. If you're earning almost nothing on your savings while paying over 20% on credit cards, the math is working, just not for you. Financially successful people ask a different question. Will this make me wealthier or simply make someone else wealthier? Banks aren't the enemy. They're businesses. Their responsibility is generating profits. Your responsibility is building wealth. Once you understand that, your financial decisions become intentional. You choose where your money sits. You choose where it grows. You choose when debt helps and when it hurts. That's how wealth is built. Not through one lucky investment, but through thousands of smart financial decisions repeated over decades. The banking system isn't going to change, but the way you use it can. You don't need millions of dollars. You simply need to stop allowing your money to sit without a purpose. Ask yourself, is my money growing? Is every dollar working? Am I building assets or simply helping someone else build theirs? Those questions can quietly transform your financial future. Because once you understand how money really works, you stop thinking like a depositor. You start thinking like an owner. Are you still keeping your core savings in a traditional bank or a high-yield option? Comment below. And if you're ready to discover the next major financial trap hiding in plain sight, where we expose the retirement traps that cost millions without warning, you don't want to miss it. See you in our next video.